gold to reach $2,750 per ounce by the end of 2024 and to $2,900 per ounce by the third quarter of 25. Goldman Sachs, who is talking about right now, by the end of the third quarter in 2025, $3,000 gold. By the end of the year in 2025, $3,080 an ounce. And this is elevated from $2,700 to $2,900 an ounce. Again, these banks are coming out and saying, yeah, we're moving to $3,000 an ounce. The central banks of the world have purchased 1,250 metric tons of gold, which is worth about $80 billion. An $80 billion infusion pushed gold up to its all-time high. At the same time, we have a strong dollar, we have positive real yields, and outflows out of the ETFs.
Gold prices are projected to reach $2,750 per ounce by the end of 2024 and $2,900 by Q3 2025. Goldman Sachs forecasts even higher prices, predicting $3,000 by Q3 2025 and $3,080 by year-end. Central banks have purchased 1,150 metric tons of gold, worth about $80 billion, contributing to its current high. Despite a strong U.S. dollar and outflows from gold ETFs, some analysts suggest gold could eventually exceed $10,000 per ounce, driven by recent demand. The renowned speaker, the president and CEO of Miles Franklin, Andy Schectman, exposes central banks are increasingly opting for dollarization as governments favor inflation over austerity. Just $80 billion recently raised gold to $2,600. If even 5% of the $8 trillion in central bank dollar reserves shifts to gold, it could inject $300 to $400 billion, significantly boosting prices, as has been seen with recent gold purchases. Andy reveals we recently lowered interest rates, and historically, according to the World Gold Council, gold tends to rally by up to 10% within 6 months after the first Fed rate cut. With rising central bank demand and ETF inflows, the case for a bullish gold market strengthens. Gold prices recently experienced a sharp decline, falling approximately $50 from record highs, as speculative positions in COMEX surged to historic levels. Hedge funds and managed money traders reached a record bullish position worth around $67 billion, a 58.3% increase since June. The banks are deeply interconnected, which is why UBS had to acquire Credit Suisse, because it was a systemic issue. Andy Schectman explains, many banks are over-leveraged and undercapitalized, leading to concerns about potential failures. There's a strong sense, whether it's intuition or speculation, that Bank of America might be sacrificed and allowed to fail. Let's explore the video in more detail. If you're finding this content helpful, be sure to give it a thumbs up and subscribe to stay updated with our latest videos. Right now, only 11% of our viewers are subscribed. Help us hit our goal of reaching 1,000 subscribers by clicking that subscribe button.
As these central banks continue to de-dollarize, they realize that inflation has been chosen over austerity, the way that all governments have. What I'm trying to say to you is this. You add that kind of money, you're talking gold that could easily be up above $10,000 because $80 billion pushed it up here to 2,600 and change with virtually no U.S. participation. And I think that you are seeing and will see kind of like a hockey stick, right, where the acceleration in de-dollarization accentuates. I can't imagine that all you would see is 5% of the $8 trillion in U.S. dollar holdings that these central banks hold around the globe would be converted to gold. I think that number will be much more. But 5% would be 300 to 400 billion injection into gold. And that's 5 to 6 times what they've already bought in the last 2.5 years, which has been the driving force behind the rise in gold. According to the World Gold Council, historically, every time we see a Fed cut, gold has rallied as much as 10% in the 6 months after the first Fed cut. So we just saw the first Fed cut. We're seeing increased central bank demand. And we're now beginning to see the ETFs start to tick up. I mean, in terms of you try to lay out an argument for a bullish case for gold, I don't know their path. And that is one of inflation. And so when you talk about inflation, sanctioning, all of the things that these central banks are thinking of, not to mention the BRICS and their gold-backed settlement currency, which again has been reconfirmed that this indeed is real and will be discussed in the meeting here in the next 3 weeks in Russia. Yeah, I think we could see much higher prices over the next 6 to 12 months, especially as we are now banking another 50 basis point rate cut. At least that's what the smart money thinks will happen. So, yeah, in every metric, gold is at all-time highs. But maybe the flawed logic is that it should be a whole hell of a lot higher, that it's been suppressed for so long that these numbers that we are all awestruck over are really well short of the mark, just because it hasn't been able to reach its real price due to the massive shorting on both the LBMA and on COMEX. Maybe, just maybe, all of these other assets that have reached such stratospheric highs, and gold and silver kind of painting a picture, allowing most people, including maybe even you and I, to sell short where gold and silver really ought to be and where it is ultimately going. And I think you can look at some of the traders at Goldman Sachs and at UBS who might echo that same sentiment. I'm sure we'll talk about that in a moment. All of these banks are systemically tied together. Why did Credit Suisse have to get bought out by UBS? Because it was systemic. And we have a situation where the banks are over leveraged and undercapitalized. And I don't know if it's a premonition. I don't know if it's wishful thinking. I don't know what it is, but there's just this overwhelming feeling that I have that they're going to sacrifice Bank of America. They're going to let Bank of America fail. Maybe that's why Warren is doing what he's doing by yanking all of his shares, not all of them, but a good portion of them. And this is the bank.
Andy highlights the large commercial banks, possibly including Bank of America, are likely struggling with their significant short positions in gold and silver. The systemic risk in the banking and bond markets is substantial, as these sectors are interconnected with industries like insurance and banking. Lowering rates may worsen the situation, especially as higher rates will eventually be necessary to compensate for risks such as inflation, default, and dollarization. Andy explains there's growing speculation that a major bank might be allowed to fail, possibly to justify the introduction of a central bank digital currency, CBDC. This could lead to a bail-in, creating widespread panic as people rush to withdraw their funds, escalating systemic risks even further. Goldman Sachs has reported a surge in precious metals requests on their trading desks, which is significant, especially as ETF holdings in gold have begun to rise for the first time in over 2 years. As the Fed prepares for another rate cut, this trend is fueling a bullish outlook for gold, which has already gained 47% since 2022, despite minimal public involvement. The dollar is weakening, and falling yields are adding to gold's momentum. Goldman and UBS are now acknowledging the strength of the gold market, suggesting that banks like Bank of America may regret their large short positions, especially as global demand for metals, including silver, accelerates. Let's dive into the interview.
Bleeding massively from their large short position in both gold and silver. Whether it's Bank of America or another major bank, I think the systemic nature of the banking system, and in particular the large commercial banks, is real. It should not be understated. The world itself is quite systemic right now. So the systemic risk in the bond market, where the bond market in and of itself is just because it underpins so many other industries, like the insurance industry and even like the banking industry. And we're going the wrong way by lowering rates, at least on the front end of the curve. So what does that do to the back end of the curve? But you end up with a situation where this is a problem for funding our deficits. Ultimately, rates must go higher. So here we are again, lowering rates and perhaps setting up these institutions to load up on treasuries, only ultimately to see rates go the other way, because at some point you have to fairly compensate people for taking on all of this risk that the central banks are illuminating here. The default risk, the systemic risk, the inflation risk, and the de-dollarization risk. So, yeah, I think systemic risk, and we've talked a lot about systemic risk, is something that it's the same way of saying counterparty risk. Counterparty risk is accentuated because of the systemic nature of everything. The domino right in front of you may not be the bad one, but it could be the 1, 2, or 3 behind you that you don't even see. Quite frankly, I'm surprised that we haven't seen a domino fall yet. If the government wants to move towards consolidating the banks, which I think they do, and I know Lael Brainerd does, to issue a CBDC perhaps soon, then I think you have to ignite that fuse. And what better way to ignite the fuse than to let a major player fail, inciting a bail-in, initiating a bail-in, which then really creates systemic risk as people in this country wake up to what a bail-in is and the ramifications of that, the consequences of that as people run to yank their money out of all of the other banks, which creates more systemic problems in nature. It's real and might be the one thing that we are underestimating totally as to the real problem with the system. Precious metals requests on their trading desks, which is a very, very, very big deal, obviously, and it is being evidenced by the first time in 2.5 years, we see an uptick in ETF holdings. And so as ETF holdings pick up, as the Fed pivots and lowers rates, probably another 50 basis points here in November, this is just rocket fuel for gold, which has done what it's done, again, rallying 29% and 47% since 2022 when we saw this divergence in 2022 where the ETF started to outflow in the U.S. and gold started to go up, really. And so this 47% gain since 2022, as the public has not been involved in it, with positive real yield and a strong dollar. Now you see dollar kind of hanging right at that 100 mark on the Dixie and could very well fall from there and drop a little bit or maybe a lot, of course. And then you see that the yields coming down and now the ETFs ticking up. This is all huge. And to see Goldman and UBS say these things, again, you can only manipulate a market over an extended period of time, done again by pushing it in the direction that it is going. And that is the key, that maybe these banks realize it's as dumb as a mud wall like Bank of America to be naked short in a market where the rest of the world is voraciously accumulating metal, to the point where just in the month of August, 8.1% of all the silver held that's available for delivery, and the LBMA was delivered 8.1%, over 25 million ounces in the month of August. So it's accelerating the acquisition of gold. And it's also being done in a manner to not upset the apple cart, as we talked about last week.
The growing demand for precious metals, central bank policies, and systemic risks in the banking sector all point to a bullish outlook for gold. With interest rates dropping, inflation concerns rising, and the potential for a major bank failure, the stage seems set for significant moves in gold and silver markets. Goldman Sachs and UBS acknowledging these trends further highlights the shifting dynamics in the financial system. How might a potential central bank digital currency, CBDC, impact the global demand for gold? Let us know in the comments section below. Also, ensure you like this video, subscribe to the channel first, and then watch the video, and turn on post notifications for more videos like this. Until next time.